Namaskar everyone. Welcome back to Finance with Sanjeev. Today we are going to discuss one of the most important subjects in finance and management accounting, costing in an organization. How costings helps control cost and improve profitability. Whether an organization is involved in manufacturing, trading, FMCG, engineering, chemicals, textiles, automobiles, or services. Understanding the actual cost of a product or service is essential for making the right business decisions. A company may have high sales and still make low profits if it does not control its cost. Therefore, costing is not simply an accounting exercise. Costing is a management tool for planning, controlling cost, pricing products, measuring profitability, and improving business performance. First, we understand the meaning of cost. Cost means the amount of resource consumed to produce a product, provide a service, or perform a business activity. For example, if a company manufactures a product, it may occur raw material cost, packing material cost, direct labor cost, power and fuel cost, factory overheads, administration expenses, selling and distribution expenses. All these costs contribute to total cost of product or business. Now we move to understand what is costing. Costing is a systematic process of collecting, classifying, analyzing, allocating, and controlling cost to determine the cost of product, service, or activity. In simple word, costing tell management how much does it actually cost us to manufacture and selling this product. Now we discuss why is costing important for an organization. Costing is important because management cannot control something that it does not measure. The major objective of costing are determine a product cost, pricing decisions, cost control, cost reductions, profitability analysis, budgeting, variance analysis, decisions making. Now we move main component of product cost. In manufacturing organizations, product cost normally consists of several major elements: raw material cost, packing material cost, direct labor cost, power and fuels, factory overheads, administration cost, selling and distribution cost. After that, we move on important tools which is used for preparing of costing. Cost sheet. Cost sheet, one of the most important tools used by the costing department. A basic cost sheet can be structured as prime cost, factory cost, cost of productions, cost of sales, selling prices. This cost is provided management with a complete picture of the product economy. We move to type of costing. There are different type of costings, different for different industries require different costings method. Number one, job costings. It is used in engineering project and customized machinery. Number two, batch costings, used when products are manufactured in batch, for examples, pharmaceuticals and food products. Third, process costings, used where production passes through continuously or sequentially process. Example, chemicals, cement, textiles, and food processing. Standard costings, a predetermined standard costings is established and actual performance is compared with the standards. Activity based costings, costs are allocated based on activities the consumer resources. This can provide better cost visibility where overheads are significant. Next tool, standard costings and variance analysis. One of the strongest tool for cost control is standard costing. Suppose the standard raw priced cost is 10,000 but actual consumption is 11,500. Therefore, there is an unfavorable cost variance of rupees 1,500. Now, management should not stop identify the variance. The important question is why did variance occur? Now we move to know how costing helps cost control. Cost controls means ensuring that actual expenditures remain within approval standards or budgets. The process can be budget, standard costing, actual cost, variance, root cause, corrective actions, monitorings. Now we discuss on cost control versus cost reductions. This is an important management concept. Cost control means keeping cost within predetermined standards or budgets. Management ensures actual maintenance cost does not exceed the approved level without justifications. Whereas cost reductions means permanently reducing the cost per unit without compromising quality, safety or customers' requirement. The question is how to reduce cost through costing. Costing system can identify several areas for cost reductions. Material cost reductions, for which negotiating better purchase prices can directly improve margins. Improve material yield. The costings team should investigate the decision. Improving yield directly reduce the cost per unit. Reduce wastage. Monitor input materials, productions, good output and scrap and wastage. High scrap indicate an opportunity for processing improvement. Reduce power consumptions. Improve labor productivity. Improve machine utilization. Now we move how costing improve profitability. The fundamental profitability equation is profit is equal to sales minus cost. Therefore, profitability can be improved through two major approach: increase revenue and reduce cost. Costings helps management identify both opportunity. We move product wise profitability. Total company profitability is not enough. Management should know which product is making money. For example, product A sells rupees 10 crore, cost rupees 8 crore, profit rupees 2 crore. Product B sells rupees 15 crore, cost rupees 14.5 crore, profit rupees 0.5 crore. Product C sells rupees 8 crore, cost rupees 5 crore, profit rupees 3 crore. Product C has the highest profit despite lower sales. Therefore, costings helps management understand sales is not equal to profitability. A high sales product may have a low margin, or low sales product may have a high margin. Now we move to custom-wise profitability. Costing can also be performed custom-wise. Suppose customer are give business of rupees 10 crore, but the customers require a special packing, higher freight, longer credit period, higher rejections. frequently a small deliveries. Customer B gives rupees 8 crores but has lower associate cost. Therefore, customer B may actually be more profitable. This is why organizations should analyze customer revenue minus customer specific cost is equal to customer profitability. Next is make or buy decision. Costing is also extremely useful for strategic decisions. Suppose internal manufacturing cost is rupees 120 per unit, external supplier price is rupees 110. At first glance, management may decide to buy, but costing must separate fixed cost and variable cost. If the avoidable internal variable cost is only 19 per unit, continuing productions may actually be better when the factory has available capacity. Therefore, make or buy decisions should be based on relevant cost, not simply total accounting cost. Now, we will discuss budget and costing. Costing and budgeting are closely connected. The organization can prepare raw material budget, labor budget, production budget, power budget, overhead budget, sales budget, working capital budget, cash flow budget. After the month ends, budget versus actuals is compared, variance are analyzed, and corrective action is taken. This creates a continuously management control cycles. Now I move to role of MIS in costings. A good costing system should produce an effective MIS management information system. A management costings dashboard may include productions, quality, sales, material consumptions, material price, yield, wastage, labor cost, power cost, overhead, cost per unit, gross margin, EBITDA, inventory, working capital, product profitability. Senior management should be able to quickly identify where are we losing money and where can we improve. Now we can move key costings KPIs. Some important KPIs including material cost per unit, labor cost per unit, power cost per unit, conversion cost, yield percentage, rejection percentage, capacity utilizations, gross profit margins, EBITDA margins. These KPIs provide management with measurable performance indication. Now we move to costing and decision making. Costing supports many important management decisions. It helps answer questions such as what should be the selling price, which product should we promote, which product should we discontinue, should we manufacture internal or outsource, which supply provide the best overall economics, where its material wastage occurring, why has gross margin declines, why has conversion cost increased, which customer is most profitable, how can we improve EBITDA, how much cost can be saved. Now I move to practical cost reduction framework. An organization can follow this 5-step approach: measure, compare, identify variance, find root cause, take corrective actions. We underestimate the complete cost improvement by an example. Suppose a company produces 1 lakh units per month. Current cost per unit: raw materials rupees 100, packing material rupees 10, labor material rupees 20, power material rupees 15, overhead rupees 25. Total cost is equal to 170 per unit. Now the costings teams identifies material savings rupees 4, power savings rupees 2, wastage reductions rupees 1, labor productivity improvement rupees 1. Total saving is equal to rupees 8 per unit. Monthly saving is rupees 8 multiply 1 lakhs unit is equal to 8 lakhs. Annual saving is rupees 8 lakhs multiple 12 into 96 lakhs. Therefore, costing has directly contributed 96 lakhs annual improvement in profitability, assuming the saving are sustainable. Important difference: costings, cost control and cost reductions. Remember this simple formula: costing is equal to know the cost control is equal to keep the cost within target, cost reduction is equal to permanently reduce the cost, and ultimately lower cost, better productivity, better pricings, better product mix is equal to higher profitability. Now we move overall benefits of costings. The major benefits of an effective costing systems are accurate product costings, better pricing decisions, improved budgetings, better cost controls, permanent cost reductions, improved profitability, better inventory management, improved production efficiency, reduce wastage, better resource utilizations, better product mix decisions, customer wise profitability analysis, supply evaluations, better make or buy decisions, a stronger management reportings, improved accountability, faster management decision. Now, final management message. At the end, I would like to highlight one important point. Costing is not only about calculating cost. A traditional approach asks what was our cost. A better costing system asks why was our cost this much, and an advanced management costing system asks how can we reduce the cost, improve profitability and increase profitability. This is a real value of costing. The objective of costing should therefore be measure, analyze, control, reduce, improve, increase profitability. Conclusion: costing is the financial language of the operation. It connects purchase, productions, inventory, sales, profitability. A strong costing systems helps management understands the true economics of business. A strong costing systems helps management understand the true economics of the business. It enables organization to control cost, reduce wastage, improve productivity, optimize resources, establish competitive pricings, and ultimately increase profitability. So, costing should not be treated merely as a finance or accounting function. Costing is a strategic management tools when finance, productions, purchase, sales, quality, and management work together using reliable cost information. These organizations can achieve sustainable cost efficiency and higher profitability. Thank you for watching. If you found this presentation useful, please like the video, share it with your finance and account professionals, and subscribe to Finance with Sanjeev, practical content or finance, costing, MIS, budgeting, treasury and financial management.